the increase in the gold price represents the deterioration in the purchasing power of the US dollar, represented by the deterioration in confidence that US and foreign savers have in the integrity of the US dollar. The gold price in the last 18 months, well, really the last 24 months, is really indicative of the fact that the reckoning is really and truly upon us. Let's look at it arithmetically. The on-balance sheet liabilities of the US government, and I'm not going to talk about other economies, which are in mostly worse shape, but the on-balance sheet of the US liabilities, pardon me, of the US federal government, not state and local government, exceed $37 trillion. And that's the number that the naysayers focus on, but the truth is worse. The off-balance sheet liabilities of the US government, represented by entitlements, Medicare, Medicaid, Social Security, federal pensions, military pensions, that number is estimated by the Congressional Budget Office at $120 trillion.
Gold has increased by more than 50%, revealing the increasing vulnerability of fiat money while rewarding those who have faith in physical assets. Such gold market movements are historically warning signs of economic weakness rather than speculative activity. According to seasoned investor Rick Rule, this is not a passing trend. After decades of careless monetary policy, it makes sense. According to him, the US economy is a patchwork of stability and strength, with rising tech stocks covering up the more serious fractures brought on by sluggish energy markets, ongoing inflation, and politically motivated policy decisions. Calls for rate cuts in the face of persistent inflation, according to Rule, expose a perilous reality. Politics has surpassed central banking. He contends that gold's ascent is defense rather than excitement. Instead of seeking gains, investors are escaping a system that is slowly and silently going into default. Governments are diminishing the value of every dollar to postpone collapse by expanding debts rather than paying them back honestly. If you want more content on precious metals investing, be sure to like, subscribe, and click the bell.
You know, the economy, I would suggest, is mixed. I'm referring in particular to the US economy. There's some self-inflicted wounds, of course, around tariffs. The underlying economy is not bad. It is, in fact, good for people who have really, truly marketable skills. Unfortunately, a lot of American society doesn't have marketable skills. The softness we're seeing in certain commodities, in particular oil and gas, suggests that the overall economy is not as strong as people would have it. And it's been a very long time since we had a recession. This is not a call because I'm not an economist. I would merely state that one would expect the oil and the gas price to be higher relative to production plateaus in the US were the overall economy strong. I note, too, that despite the relative strength in the US economy, that there's a lot of political pressure in the United States to cut interest rates, which is an odd thing to do with CPI stated inflation fairly stout, and the overall economy is very strong. It speaks to the politicization of the US economy. And I think that this inflation and this politicization, on top of the debt and deficits experienced in the US and in other countries, is an easy way to explain and an accurate way to explain the incredible strength that we've seen in the gold and gold equities markets this year. The gold price in the last 18 months, well, really the last 24 months, is really indicative of the fact that the reckoning is really and truly upon us. Let's look at it arithmetically. The on-balance sheet liabilities of the US government, and I'm not going to talk about other economies, which are in mostly worse shape, but the on-balance sheet of the US liabilities, pardon me, of the US federal government, not state and local government, exceed $37 trillion. And that's the number that the naysayers focus on, but the truth is worse. The off-balance sheet liabilities of the US government, represented by entitlements, Medicare, Medicaid, Social Security, federal pensions, military pensions, that number is estimated by the Congressional Budget Office at $120 trillion. Now, to put that $120 trillion in perspective, gross federal income at the United States, revenue into the federal government from all sources, before they do anything like pay salaries or bomb foreign countries or whatever it is they do, is only $5 trillion. So you're trying to satisfy an obligation with a net present value, not a nominal value, a net present value of $120 trillion on gross income of $5 trillion before other expenditures. That doesn't work. There's two ways out for the United States. One would be an honest default, which is where you say to the bondholders, yes, we realize we owe you $37 trillion, but we don't have it. And you say to the Medicare and Medicaid recipients, the Social Security recipients, say some old codger like Rick Rule, yeah, you paid in for 60 years, that's right, we understand, but there's no money. So we're going to renege on part of our promises. That honest default isn't going to happen. We're in the midst of a dishonest default, where we honor the nominal value of our obligations to our bondholders and to entitlement recipients, but we inflate away the net present value. My belief is that over the next 10 years, in an absolute sense, the US dollar will lose 75% of its purchasing power. Not in a relative sense. I don't think that the US dollar will do badly against the pound, against the sterling, against the Canadian dollar, against the Australian dollar. Countries that have the same circumstance, but maybe less resilience than the United States. But I do believe that in an absolute sense, the US dollar loses 75% of its purchasing power. That's a consequence of the fact that we've lived beyond our means for 40 or 45 years. The gold price, I think, is a reflection of that. I'm not certain that the gold price, which has risen in nominal terms from $253 an ounce in the year 2000, I'm not certain in a real sense that the gold price is up at all, but in a nominal sense in US dollars is up 9% compounded. I would suggest to you that as a consequence of our society living beyond its means, that the increase in the gold price represents the deterioration in the purchasing power of the US dollar, represented by the deterioration in confidence that US and foreign savers have in the integrity of the US dollar. If people ask me what would cause me to sell my gold, I say a cessation of the problem. If I saw some chance of a balanced budget in the US, by the way, the budget is in excess of $2 trillion in deficit today, or if I saw the ability for a political resolution of the entitlement liability, or if I saw positive real interest rates in the United States. By positive real interest rates, I mean an interest rate on the US 10-year Treasury that was in excess of the rate of the deterioration of the purchasing power of the US dollar, then I'd sell my gold. I believe that while the official statistics around inflation, the CPI, suggests that inflation as defined by the US government is running by 2.9% a year, inflation defined as the deterioration in the purchasing power of the US dollar relative to the basket of goods and services acquired by US families. By that definition, I would suggest to you that the purchasing power of the US dollar is declining at about 8% compounded. A real interest rate then would mean that the US 10-year Treasury would have to yield some number in excess of the rate of deterioration of the US dollar. The US 10-year Treasury right now yields about 4.5. In the circumstance that would cause me to sell gold, the US 10-year Treasury would have to be yielding 10 or 10.2 or 10.5, a circumstance that I don't think will occur. I think as a consequence of negative real interest rates, on-balance sheet liabilities and off-balance sheet liabilities, and the need to print to honor the nominal, not real value of those obligations, that the purchasing power of the US dollar declines by 75% over 10 years. And at least the nominal gold price likely mirrors that decline over 10 years.
Rick Rule cautions that years of foolish debt, political manipulation, and waning trust in world monetary authorities are all contributing factors to the recent spike in gold and silver prices. The US economy, according to him, is a system that is kept together by inflated asset bubbles and temporary political solutions that conceal its underlying flaws. Rule contends that the lack of integrity within the very organizations tasked with managing inflation is the true issue, not simply inflation itself. The underpinning of the entire financial system started to erode when central banks began acting in accordance with political agendas rather than good economic principles. Rule sees the metals rally as self-preservation rather than speculation because of this. The fact that paper riches is based on unfulfillable promises is causing investors to wake up. Gold and silver, on the other hand, are tangible assets that are trust-based. Show some love by hitting the like button, subscribing to the channel, and turning on notifications. Now, let's get back and hear his following words.
We, in the United States, dealt with it at the end of the decade of the 1970s. We allowed the interest rate to rise to market levels, which is to say 18%, which broke inflationary expectations, broke a lot of people too. And while we didn't reduce the size of government, we reduced the rate at which government increased. The Reagan Revolution, despite its sort of vaunted anti-government stance, was derailed by politics. We didn't reduce the size of government at all, but we reduced the rate of growth of the US government in the period 1980 to 1992 fairly dramatically. That allowed the economy to grow at a pace that was more able to afford our collective stupidity. And I suspect what happens in the next 10 years is not dissimilar to what happened then. I expect ultimately that the market will get in control of the long-term interest rate, not the Fed. That'll have fairly profound implications in terms of the cost of capital. And I believe that 10 years from now, I hope, we will slow the rate of growth in government expenditures and hence government debt. I think with regards to entitlements, that we will reform entitlements. I think as an example with Social Security, they'll say to some fat old rich guy, Rick Rule, you know, the idea that your taxation for Social Security ends at $160,000 income is going to go away. You're going to have to pay in just like everybody else at all levels of income. In other words, there's going to be a huge tax increase for productive shareholders, productive taxpayers. The second thing that happens is they're going to look at me and they're going to say, no matter how much you put in, we're going to means test it because we can't afford to pay you. So there's going to be a straight transfer in Social Security where they steal money from folks like me in terms of how much they tax, and they don't pay them anything. That's called theft. That's going to happen. The other thing that's going to happen, and it should happen, they're going to means test all entitlements, but they are going to increase the eligibility years in Social Security. When Social Security was instituted in the United States, it was meant to provide poverty level income from age 65 on. That's an important stat because the average life expectancy of an American male at the time they instituted Social Security was 66 years. So the program was meant to sustain the average American at a poverty level of existence for 1 year.
Rick Rule considers America's history and makes inferences about its future. He remembers how the United States experienced unchecked inflation in the latter part of the 70s until the government permitted interest rates to increase to about 18% of real market rates. It was a hard adjustment that required economic discipline and broke inflationary expectations. Reagan's administration didn't actually cut back on government, but it did slow down expenditure, which let the economy expand and bounce back. Rule thinks that history is going to happen again. He anticipates that markets, not the Fed, will govern long-term interest rates over the course of the next 10 years. He claims that this change will have a significant impact on borrowing costs and economic expansion. He believes that someday the American government would have to cut back on spending and restructure entitlement programs. For instance, there will probably be tighter eligibility requirements and more taxes on the wealthy for Social Security. He makes a joke about how wealthy retirees like him will be told to contribute more to the system while getting less in return. Rule also draws attention to the widening gap between living expenses, skills, and wages. He notes that for many years, the American economy has prioritized consumption over creation. While the educational system emphasizes low-value disciplines over practical, technical abilities that provide true productivity, the tax code favors spending rather than investing. Many workers consequently lack the money and training necessary to obtain greater earnings. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.